The time value of money. There are two sets of data that we use in corporate finance, retrospective and prospective. Retrospective data is compiled in financial statements. These represent the historical performance of an enterprise and can be analyzed, compared, and extrapolated. Ratios are the tools of financial statement analysis, and we just discussed them. Prospective data is compiled in financial projections. These represent management's forecast of how the enterprise will perform in the future. These projections can be analyzed, risk-adjusted, and a present value of those future cash flows can be calculated. We will now get into the forward-looking aspects of finance with the concept of the time value of money, or TVM. Time is money, literally. If there is a prospect of receiving a certain sum, then the sooner you receive it, the more it is worth. Interest rates describe this relationship between present value and future value. This is the fundamental concept of finance. We will explore this relationship between present and future value from different angles, and I will phrase it in different ways in order to let it sink in. The time value of money represents the conceptual basis of finance. This is the underlying principle of how banks function, how stocks and bonds are priced, how assets and companies are valued, how projects are analyzed, and how you should think about the nature and function of money. A bird in the hand is worth two in the bush. Receiving money today is worth more than getting the same amount in the future. And the value of the prospect of receiving money diminishes the further into the future the promise to deliver that money. The rate at which the value of $1 in the future decreases relative to $1 today is inversely proportional to the rate at which $1 invested today will increase in the future. Take a second to let that point sink in. The future and the present value are two sides of the same coin, pun intended, and they are related to each other by the interest rate. The concept of the time value of money explains why interest is paid or earned. Interest, whether on a bank deposit or debt, compensates the depositor or lender for the time value of money. Risk has to do with the uncertainty of being repaid, and interest rates reflect this level of uncertainty or risk. One of the reasons credit cards have such a high interest rate is that the risk of other people defaulting on their balance is baked into the rate. The time value of money also underlies investment. Investing is about managing risk versus return. An investor is willing to forego spending their money now if they expect a favorable return on their investment in the future. The return required is related to the perceived risk of getting one's money back in the future. The higher the perceived risk, the higher the required rate of return. An investor is willing to part with their precious capital when their greed overcomes their fear, where the expected return exceeds the perceived risk.